Hey guys, Price Detail here with you again, bringing you some educational content. And today we're going to be talking about ordinary shares versus preference shares. Now, in my previous videos that you can go and watch, I've already explained what is ordinary shares or what are stocks, right? These are basically ordinary shares. But today we're going to be having a comparison between these type of shares and preference shares. Now, basically, both of these are stocks that are issued by a company or corporation or whatever. But there are some key difference between them. Now, ordinary shares, right? These can be bought and traded on the stock exchange, right? And for these type of shares or stocks, if you will, these carry a higher return, but they're at a greater risk, right? Because as I said, these are ordinary shares, so the risks are greater because you're trading them, so there's risk of either the stock losing its value, or the amount that you initially bought into, it's not a guaranteed return on these kind of stocks, right? However, for these type of shares, you can make profits through dividends and are selling your stocks. So these are your options as it relates to making profits on these kind of shares. But as I said before, it's a risk. So we all know a dividend is something that a company will give out as a form of payment, or form of basically your a profit that is made. So when a company makes profit, company can decide that okay, then it's going to share its profit with its shareholders, which is you guys, the investor, right? So they will give a percentage based on the amount of stock that you have in that company, or the percentage of stock that you have in that company. That will determine the amount of dividends that you gain from these stocks, right? However, you as an investor, and the fact that you're a shareholder or an owner or a part owner of the company, you do have rights to voice your concern in these company, and you normally do this through what you call a annual general meeting, right? So company will keep this meeting every year, invite shareholders to come in, and they will basically give you an update, how the company is performing, what are the goals, what product services will be coming on stream, or those information that is needed for you as the investor to ensure that you know exactly where your money is and where and how your money is being spent, or your investment rather is being spent. Now, in contrast to these, as said before, preference shares, these are another issued by the company as well. However, these carry less risk because as the name suggests, these are preference shares, right? So the company issue these shares to you and with an agreement to say, okay, then you'll be making a specific amount of interest per annum, right? And so let's say a company will tell you, okay, the issuing of preference shares will last for, let's say, around 5 years at a 6% per annum. So it means that if you, let's say, put in, and they most of the time they will give you a minimum amount that you can put, you can start, you can come in with that investment. So let's say the minimum amount is $100,000. You will be getting, so that $100,000 is invested, and you will be getting 6% of that $100,000 per annum. Now that's the maximum amount you'll be getting per annum. However, companies will then tell you that all you're getting that per annum as interest, but they're going to be paying maybe quarterly. Some persons pay quarterly, some biannually. So with that being said, it means that, okay, 6% of that $100,000 you'll be getting per year, and if it's biannually, that 6% will be split in two, so that will be 3% every 6 months. If it's 4, that 6% is going to split in fours, right? In four parts, giving you every quarterly, right? So that's how they will normally, give you preference shares, how you will make your profit from preference shares. And you basically can consider this a dividend. So that's how you're paid. However, for these, you can't necessarily trade these kind of stocks on companies, not like how you do the ordinary stocks. So you can't trade these on the stock market to say, okay, you're going to buy and sell and whatever, right? These are this kind of investments. Most of the time it's locked away, so you can't add to this investment after you have made your initial investment, right? So you can't add on that $100,000 to say, okay, you want to increase your the amount that you can get after the 5 years or the quarterly interest rate, right? So yeah. But as I said, it's less a risk, and you make profit through the dividends or the interest, and you, unlike ordinary shares, however, you have no right into the company, right? You cannot voice, or you cannot make decisions as to as it relates to the company itself. You don't really have any say in the company. However, one of the greatest thing about preference shares is that, as the name suggests, it's preference share. Now, while ordinary shares, you're not guaranteed a dividend payout. You're not guaranteed a dividend payout. At preference shares, it's a guaranteed. As I said, it's a contract where they're going to, where I stated before, $100,000, you're guaranteed to, if they tell you biannually, you're entitled to that every 6 months payout or every 4 months payout, whichever the agreement is. This is a guaranteed, and that's why it's called a preference share. So if a company, let's say, makes some profit, and let's say the company made $100 million, and of that $100 million, let's say the preference shares is $100 million worth of investment, that preference share is going to be paid out first and foremost. So it's a must, and you might not get anything from ordinary share, because if they don't have any cash flow to pay out ordinary shares, you're not guaranteed it. All right, so those are basically the main differences between ordinary shares and preference shares. Preference shares, as I said, less risky, so it's more most of the time these shares will go for the conservative. Not to say that anyone can't go in, but persons who want less risky investments, they will want to lose their money, and persons who might just starting getting into stocks, this can be one of your options to say, okay, at least at the end of the day. Additionally, after that 5 years, what happens is that after that 5 years or 3 years or any amount of time that's the agreement is that they tell that they're going to hold it for, you'll get back your principal, which is your original investment amount after. So you'll get that after that 5 years or after that period is finished, right? So yeah, you don't lose any money. You don't lose your money, right? but as I said, it's less risky, and you can make you more than likely will make less than if you're in ordinary shares. But you can it's a good way to get into the stock market, if you're not the risky type of person. So that's my take today, guys, and I hope y'all find this informative and educational. And I will, if you find it any of these information, to your liking, I would like you to comment, like, share, and subscribe to our channel. Right, more educational videos coming soon, and I hope you all enjoy your day here at Price Detail. Blessed.